Hello, my name is Nadin with Schoolmonk YouTube channel. Today I will be talking about how to bootstrap growth your business, your Amazon business. So how fast can you grow your Amazon business without taking on additional debt or raising capital, pretty much. So the selling on Amazon is very cash intensive business. And you have to manage your cash carefully, or else it's game over for you. If you have a cash crunch, then it can be game over for the business. And we've had cash crunches in the past, and it is definitely no fun at all. We've had to make some major changes to get the cash back into the business. And so, because Amazon is a very cash intensive business, that means that if you want to double your sales, you will need to double your inventory, all else being equal. So that means you need double amount of cash. So the question that comes up is, should you take on more debt to grow? So there's uh, pluses and minuses to both sides of the argument. We've taken on debt to grow to where our level, and we continue to have to service that debt. But the benefit is it'll give you more cash to grow your business. The downside is that taking on more debt will burn your business with the amount of cash you have to service the debt, the monthly payments that you have to pay, and also on top of that, you're also paying the interest, which will reduce your profitability on your business. And then the negative side is you're risking additional money that you don't have. So if you make a mistake, you order wrong inventory that is basically dead inventory. You can't sell anymore. So that inventory you have to write down is basically additional. That's basically money lost. And if you borrow that money, that means money you didn't have in the first place. So that puts you in the hole. So you gotta make to cover that hole, to make profit in the future, to cover that hole. And the other thing that we've seen in our business and other businesses that we've been associated with in Amazon is taking on more debt will mask over the problems you have. Oftentimes, the reason you're having to take more debt is for growth, one of all. But when you have extra money, that's just human nature. You tend to gloss over the problems that you should have addressed sooner, especially that we found is like the underlying issues like payroll or employee related that you should have made sooner. You should have let that person go sooner, but you delay that, especially if you're a people person or if you care for your employees like we do. This is a death temptation that we've fallen to in the past. And so basically, taking on more debt just mask over the underlying problem, whether your problem is a profitability problem or margin problem, or the inventory turn problem. It just masks over that problem just because you have more cash on hand. So what we found, the formula for growth without taking on more debt is basically net profit minus income tax divided by the highest inventory balance you have. So net profit is basically your profit that you have at the end of the year. And keep in mind that this is after you take out your owner's draw, and if you take out money from the business to renovate or to buy a car or whatever, it's gonna reduce the amount of cash you have. So it reduce this, this amount that after net profit you have available in a month to invest in your business. So we're talking about reinvesting the money that you have as profit. So basically, if you don't have any profit, then you can't grow, because you can't grow without more debt, because you don't have any money to reinvest into the business to grow. So the other, after you net profit, you also have to subtract out income tax. So we're assuming that you're not taking any more payroll or owner's draw out of this, and you're reinvesting all your business. So you take your net profit minus income tax, then you divide by your highest inventory balance, which is this inventory balance. The highest inventory balance is like your cash pile that you've invested, the amount of money you invested in the business. So we're gonna take that formula and figure out what the highest growth is. So this example is the widget company. Basically, it makes $1 million sales. The cost of good is $300,000, or 30%. And then Amazon selling fees 150K, FBA fees, and then advertising PAG, my friend Tyler Jeffcoat defines it as post-advertising gross profit. So, GAAP accounting tends to move this advertising into the expenses column, but for our Amazon business, it's more clear to move this advertising because it's part of that variable growth that the more sales you have, the more advertising you have. So it makes more sense to move it above the into COGS rather than into expenses. Sorry to get into a little bit of accounting there, but basically the post advertising growth is 250, and then the net profit in this example is $50,000. And to generate that $50,000, the average inventory balance is $60,000 because most inventory is seasonal, like if you have Christmas season. And the highest balance it got is $90,000. So basically, you put $90,000 at risk, and you got $50,000 in net profit. So if we use that formula, which is $50,000 in net profit, and then you pay Uncle Sam 33%, and then you divide by your highest inventory amount, to get your highest inventory amount, just if you're tracking it month to month, that whatever the highest amount is for the year, that is the amount that you get. And then so basically this formula shows that you can grow 30% next year. That means that you can take that 30%, 7%, add 1 to it, and multiply by this year's sales. So basically, next year's sales, you can do $1.37 to $1 million in sales. So this is assuming all else being equal, of course. But basically, this is the formula that will allow you to grow, bootstrap, without taking on more debt or without having to borrow, beg or whatever, or raise capital to safely grow this and not put the business at risk. So that, in summary, that formula, allows us to calculate the theoretical limit of growth without putting our business at risk. So I will be using this formula going forward to help our company adjust for growth, because we've grown exponentially in the past, and we had to borrow a lot of money, and that got us into this trouble of the risk that I was telling you about, all these trouble. And so going forward, we're going to try to grow more reasonably, responsibly, by using this formula so that we know how much we can grow each year. All right. Thank you for watching my channel. If you click like and subscribe to my channel. I'll be doing more business operations, how to improve your business videos like this going forward.